Welcome to Talk Tickers, where we break down the earnings calls that really matter. Today, we're diving into Synaptics' first quarter results for fiscal 2026. The numbers look pretty good, but the stock's reaction, well, that told a completely different story. Let's get into it.
Okay, so let's tackle the big question right off the bat. On the surface, things looked good. Synaptics actually beat Wall Street's estimates. And yet, the stock took a nosedive, dropping nearly 6%. So what's going on here? The market was clearly sending a message, and we're going to unpack exactly why.
To really get what happened, we have to start with the headline numbers. How did they actually stack up against what Wall Street was expecting?
As you can see, Synaptics delivered a modest beat on both revenue and earnings per share. Revenue came in a couple million higher than expected, and their non-GAAP EPS just nudged past the high end of the consensus range. So, on paper, this looks like a win.
Now, here's where it gets really interesting. That $1.09 EPS number, that's a solid 35% jump from last year. In this kind of tough economic climate, that's some seriously impressive growth on the bottom line. But you gotta ask, where's that power coming from?
And here is your answer. This is the engine. Their core Internet of Things, or IoT business, just exploded, surging an incredible 74% from the year before. This is the part of the business the company is banking its future on, and man, they are absolutely crushing it here. But let's dig a little deeper into the different parts of the business, because that amazing 74% growth number, well, it doesn't quite tell the whole story, and it creates a much more complicated picture for investors.
You see, while IoT is the clear growth story, it's still only about a third of the entire business. The majority of their revenue, we're talking over half, still comes from their older legacy enterprise and automotive segment, and this mix is absolutely critical to understanding why the market reacted the way it did.
So what you have is this classic tug-of-war happening inside the company. You've got this explosive growth in IoT, which is fantastic, but it's getting dragged down by weakness in their bigger, more mature markets. Management was really clear about this, calling out soft demand in auto and supply problems in mobile. It just creates a very, very mixed picture.
So, how does Synaptics plan to break out of this cycle? Well, they're betting the farm on the next big thing, Edge AI. Think of it as AI processing that happens right on your device, not way up in the cloud, and their entire strategy is built around their new chip, the Astra processor.
But, and this is a big but for investors, look at this timeline. Management's talking up design wins they're getting right now for Astra, which is great. But the first real money from it, that's still over a year away, in the back half of 2026, and the even more advanced stuff is way out in late 2027.
And this is the fundamental problem. You have this exciting long-term promise of AI clashing head-on with the market's verdict on how the company is performing right now, and that long, long wait for a payoff.
I mean, this chart just says it all, doesn't it? Over the past year, a time when the broader semiconductor sector, that's the SOXX ETF, has rallied a whopping 26%, Synaptics is actually down 13%. So despite that incredible IoT growth, the stock has been a massive underperformer.
And if you want another layer of proof, just look at the short interest, around 8%. That's a pretty significant number of investors who are actively betting against the stock. It shows that Wall Street is still really skeptical that this long-term AI story can overcome the headwinds the company is facing today.
So let's put all the pieces together. Here's our take on what's next for Synaptics and what we'll be looking for on their next earnings call.
We're going to break it down for you in 3 simple parts. First, what we expect for next quarter. Second, how we think the stock is going to trade. And third, our final definitive rating.
Okay, so management's guidance for the next quarter is actually solid. They're projecting some nice sequential growth. But the underlying narrative hasn't changed one bit. Strong IoT is getting weighed down by a soft auto market. This makes Synaptics a classic show-me story. Investors need to see proof. And until that AI strategy starts showing up in the actual revenue numbers, the stock is likely going to stay choppy and probably keep lagging behind its peers.
So, all that brings us to our final rating, market perform. You've got strong execution in their key growth area, which is great, but that's balanced against these stubborn headwinds in their legacy businesses and the super long wait for that AI catalyst to kick in. The potential is definitely there, but the timeline and the risks involved just keep it from being a clear outperformer right now.
And a final reminder, this analysis is for informational purposes only. It is not financial advice.